You guys had 2 problems to do in class, and then a couple more to do on your own. Excuse me. And I don't know if we'll be able to finish this one. This put a question mark here. Finish? Maybe. It's chapter 3. Now, there's a lot in there. It's really important stuff, though. All right, so let's see. Oops, let's go to classical sampling, and we did first problem. So now we're on problem 2. Okay. Well, here's problem 2. All this so we can see it. Okay, so they have accounts payable, the book value of 500. So this comes from the client. This is what the client gave you. This is the no, this is the book value. This is what the client gave you. And as an auditor, this is what you have to check on. You know, is this materially misstated? And we do a test of we go through other accounts, and we decide we need a sample of 10. Might be a little bit small out of 1,000, but it doesn't matter. So, the procedures are the same. Okay, so we have to calculate a book value for the, okay, so let's get, I'm just gonna do it here. Just let more room here. All right, we need the average for these. So we're going to divide by 10. By 10. So these will be the averages. Oops. It's nice and simple, so you just have to lop off the last 0. And that's not the right one. Wait, yeah, it is right. Okay. I'm gonna do that differently. Okay. So the average book value is this. Audit value is that. By the way, if I do anything wrong here, let me know. I think that's right. Okay. Copy these down. Why do I give so much room up here? Anyway. Now, what I'd like to have everybody do is, memorizing. If you're taking a CPA exam, you try not to memorize. You memorize those things you have to. Most of it you try to learn. The things you can't learn, you memorize. And there's only so much you can memorize. So, one of the games you kind of play is what do you actually learn and what do you memorize? I'll give you an example. When I took the exam, pensions was brand new, and it was really hard for me. I couldn't make heads or tails out of it, so that I memorized, and I actually did okay on those sections because I memorized them. But most of the other stuff I learned it. Oh, okay, this makes sense. But those things that you really just can't learn. I couldn't make heads or tails out of pensions stuff, so I memorized. Ironically, later I worked for Navistar, and we were huge into pensions. It turns out like this isn't wasn't that hard at all, but it just didn't click for me at the time. But anyway, so some stuff you memorize and you try to memorize that, but sometimes you try to learn. And the nice thing about classical sampling is the actual name of the kind of tells you what to do. Mean per unit. Mean is just average. So this is kind of like the average per unit. And I think we talked about this last time. Whose average do we believe in more? Which one is more persuasive to us? The one that the client gave us or the one that we did ourselves? The one that the auditors did.
The auditors?
Yeah, this one, we put a lot more stock in this because we actually went out and looked at it, and this is what we came up with. Whereas this is something they handed to you. It's a little bit like hearsay, here it is, and we say it's okay. Whereas this one is actually, so this is the more persuasive of it, and that's always true in auditing. It's more persuasive. Okay. My wife's an English major. She cringes when I start writing something. Oh, he's gonna mess it up. All right. Yeah, what we do ourselves is more persuasive than what someone else gives us. So what we're going to do is say, okay, every item in their sample, mean per unit, every item in their sample should have the same amount. So they have a total of 1,000 accounts payable. Knock that down the side. And we're saying that each one of those is worth this. Okay, hey. Oh, that should be easy, right? This is it a, what is it? Did I put that in here? I must have. Okay, so this is our projected value. We're saying that, oops. So this is our projected value. So we're saying that this is the amount that we think those accounts payable are worth. I'm gonna go all the way back up here. I want to see how I did it here. Okay, I'm back. Okay, so our total book value we have, and this will be the same on all of these, is 5 million, I think. Yeah, so the client gave us this. The client said, yeah, that we owe $5 million. So we come down here, we say, okay, they tell us that they owe $5 million. We say they owe $5,314,000. So we have a projected misstatement of, oops. Is that 314,000? Now, are we saying their books are overstated or understated? Okay, so let me paste these up here. So, are their books overstated or understated?
Is it understated?
Yes. We're saying they should be 5,314,000. They're only saying it's 5 million. So these are understated by 314. Now, again, I think I mentioned this before. When you do your sample, when you're doing your sample, everybody should be able to do the sample and get the same results. In other words, I come up with the same result here, projected misstatement 314. The second, the reason why we're doing this is to see if they're misstated. The determination of whether this is materially misstated or not is a judgment call. So someone might say 300,000 is not material. It depends on how big the company is. But someone else might look at that and say it is material. So that is a judgment call, and the CPA does not usually test you on things like that. But what they will say is like everybody should get the same number. Regardless, everyone should come up with 314,000 as what is misstated by. So they usually just test on, they'll ask one of these three things, and usually a lot of times these are multiple choice questions now. Okay. Ratio analysis. Ratio analysis. Now, this one can be a little bit tricky. The question is, it's a ratio. Which one do you put on top? And we're going to find out that audit value goes on top and book value goes on the bottom. They're alphabetical. A comes before B. So audit value is on the top. I should say audit average. Audit average is on the top. Actually, you could do it by this too. This ratio, the ratio one, you could actually do it by the total amounts too. It'll be exactly the same. Okay, so the audit value is 5314. And we're going to divide it by book average. 5140. And so what this one is telling us is that there is a ratio that they're off by. That it's not a static amount, it's that everything is off by the same ratio. Oops, no, not equal. And we're going to multiply that by the total book value. We're saying everything in that book value is off by, oops. Hey. Same amount. So we're going to, so this will be the book value, which is this. I know, I can make that red. It'll distinguish it from the other ones. Because this is what they gave us. And this will give us our projected misstatement. Calculator. Okay, so 314. I'm going to round it off the nearest dollar, so you know. Hey, that's a much bigger one, isn't it? All right, looks like 5,100,000. Let me write it in here. 5,169,261-ish, something like that. So this will be our projected value. Okay, so again, doing the same thing here. Total book value is the same, total projected value is different. And so this is. Oops. Okay, so let me copy these up here. Okay, is this overstated or understated? You're saying that books are too high or too low?
Understated.
Yep. Yep, there you have it at 5 million. We're saying they owe a little bit more, they owe 169 more. And again, this is a judgment call whether that would be material. Okay, difference estimation. This was kind of a wacky one anyways, but difference means that what? You say the difference between something, you subtract them. And so we're gonna subtract our audit over our books. Let me go back and see exactly what I had put up here just to make sure I'm doing it right. Audit over books, yep, okay. By the way, that alphabetical thing that I told you about, like, this is alphabetical, the ratio estimation. You'd be surprised how many things in accounting are like that. The rate, the ratio, you do it alphabetically, or whenever you do subtraction, you do it alphabetically. Like if I ever write a book, I'm gonna be the alphabetical theory or something. But yeah, so audit, and again, we different estimation, we'll do our audit value minus our book value. Matter of fact, it might just kind of be the teaching you guys how to be lazy like me. That's my real goal in this class. But to lazy people like myself take over the world. Okay, so difference means that we subtract them. So we're going to take our. So it's got to be bigger, isn't it? Why is it? Oh, they are the same size. Okay. Okay, so 5 minus 10. So we'll get the difference. These have to be different sizes. Why is this one so much bigger? Okay. Okay. All right, so the difference. Is 174. So we're saying that everything here is it overstated or understated? If we're saying that everything on their book should be 5,314, and they're saying that it should be 5,140, are we saying that these are all understated or overstated?
Understated.
Yep. So these are all understated. So 174,000. Now we have 1,000 of these accounts. This is gonna look ugly. No, doesn't look too ugly. Yeah, it looks fine. All right, 174,000. So this will be the total amount that is understated. And this is where it gets tricky. Because we have to back into our projected value. And I have to fix my spacing. Okay. So our projected misstatement is sorry. Projected misstatement is that. So we have to back into this projected value. Can I make that look? Yeah. All right, so let's just wipe it out here. So what would be the projected value if we're saying that it's understated by 174,000?
$5,174,000.
Yep. So this one's a kind of wacky one in that you have to back into the projected amount. And again, these are three different methods. They all use the same data. They all use the same book average and audit average. But they come up with different projections. And again, judgment call whether the projected misstatements are material or not. You know, if they are material, we'll ask them to correct it. If they're not material, we probably won't. It kind of depends a little bit. And sometimes you'll have clients that'll want to know, you know, even if it's not material, like what did you find? That's very common. Figure out where the problems are. But you know, like for instance, up here, well, like for this one, you know, sometimes they'll say, well, which ones were off? You know, and you'll tell them, okay, look at number two, item number two, you know, was out with what, 700? And they may want to know that so they can correct it and maybe figure out why it was off. You know, and same with three here, and I kind of cook these a little bit to make them more exciting, but you know, it's possible that they want to see what those are anyways, and oftentimes they'll do that. When I was doing internal auditing, we did this kind of stuff all the time. We wanted to know why is this account off? We were actually looking for accounts that were off rather than doing a you know, looking for whether they're materially misstated. Um, I'll let you guys, how many are left here? I'll tell you what, so we'll do one more of these and I'll let you guys do number, so this one will be homework. And it's similar to the one above it. But I also want to go over the ones down below here. And the reason why I want to do like number 4 is this is kind of more like what you would see on the CPA exam. The idea is exactly the same, but a lot of times they don't give you the breakdown of what accounts they were and all that kind of stuff. So let's go ahead and do this one together. And then you can do number 5 together. Or no. Gotcha. Do number 5 on your own. Okay. So this is kind of the way, a lot of times, the way you'll see it given on the CPA exam. They may even give you the average, you know, sometimes they'll give it to you, you know, they'll say, here's the average. They'll give you those two. But if they don't, if they give you, here's the sample, you know, we got a sample of 60 and they want you to calculate, make sure you know how to calculate those averages. I got these turned around a little bit. No, it isn't big. They can give it to you any way they want. Anyway, so we have a sample size of 60, and I'm just going to do it right here. Find the averages. Do that in my head. 300. And my head's not so good anymore. It's 30. I think I didn't do it in my head. All right. So the auto value. So I'm going to make sure I label that one. That's the green one. And this one. $33. Yes. Oops. I write it incorrectly. So here is the book value, is what the client gave us. So the audit average is, I got it in the same order. So this one would be okay, so yeah, so this is, and this kind of way, a lot of times they'll show it in the CPA. And by the way, when, you know, I actually just wanted to email you guys and apologize. Is there anyone who can still not get into the book, the ebook? I'm getting a list of people together. Some people have been able to get into it, some people haven't. Anyway, I'll send out an email asking for anyone who cannot still get into that ebook. But okay, the author of this book, the Whittington book, that author also writes the Wiley CPA review, and everything he does is like it's on the CPA exam. The reason I say this, there's a lot of auditing books that have all kinds of different ways of doing sampling. The way they show it here, though, is the way you see it on the CPA exam. And it's kind of a more, you know, clean, less cluttered kind of a way of showing it. That's one of the reasons why I like this book, though, is that it actually is done by somebody who makes a very popular CPA review. Okay, mean per unit. So mean is just average. Who's average? The book or the auditors?
No auditors.
Auditors. So this is, what do we have? Okay. Similar. And by the way, you know, different companies, different audit firms will have their own way of doing these, of doing a sampling. And they'll all kind of give you the same way of doing it, you know, doing it their way. And they're not doing that to be evil. They're doing it because it's kind of a quality thing, so that they know, every senior auditor, every manager, every partner, they'll look at it and they'll know exactly what you're doing because you're gonna do it all the same. So this is our projected value. We're saying that everything should be $30. Okay, they're saying that our book value was 700,000. We're saying the projected value is 600,000. So our projected misstatement is 100,000. Overstatement or understatement?
Overstated.
Yep, overstated. Good. Yeah, they're saying it's 700,000. We're saying it's only 600. Okay, there's something. So there's 700,000. We're saying it's 600. Oh. Oh, overstated, right? Oh. But we're saying it should only be 600,000. I'm saying so. Okay, let's go to the second one, ratio estimation. So ratio estimation, we take alphabetically audit value over book, audit average over book averages. So we're saying everything is up at the same ratio. I'm going to multiply that by 700,000. Some number. Six three six 3 6 Break that down. Yeah, I'm rounding off the nearest thousand. We got projected value. Okay, so. No. All right, and the projected, what? Yeah, 63636. Okay, now you guys should really check this one, because this is one of.
That's right. 63636.
Okay, thank you. All right, so that's the projected misstatement, overstatement or understatement?
Overstated.
Overstated, yeah. By the way, you can have them, I think on this one we have it, when you do this one, I think you'll have an understatement and an overstatement on different ones. Maybe we'll go over it next week, we'll go over it next week. Okay. Difference estimation, this is where we say that there's a difference between them and we will. Everyone should be off by the same amount. All right, and we take audit average, tracked out, alphabetical. And look at a difference. And so here's what we're saying. We're saying that everything should be off by the same amount. Everything should be off by what, $3? So is this an overstatement or an understatement? Are we saying that everything is off by an overstatement or an understatement? Is everything on their books too high or too low?
Too high.
Yep, overstated. Sales. I can't say that. 60,000. Oops. Okay, so this again is the strange one where we're saying that this is everything is overstated. We get the projected misstatement first. I don't have enough room here.
So 640,000.
640, thank you. Oopsie daisy. Okay, so let's see, the predicted misstatement is 60,000. Yes, it's for you. And again, this is we shall get the same number. Whether it's material, it's a judgment call, and they don't usually go into that CPA. So these are all overstated. I think on this one, I think one's understated, one's, I don't know, I can't remember which, they're a mismatch. And we'll talk about it next class. Okay, so maybe do this, so this one will be the homework, will be also be homework. So you're doing 3 and 5 is homework. And 3 is like 2 and 5 is like 4. Now I want to go to the very end, and you might be wondering, well, when do you use these? You know, you have these 3 different things, and they can come up with very different answers. And which one do you want to use? And it really depends on what your sample looks like. The characteristics of the sample will determine which one of these you use. Mean per unit is appropriate when. Oops, let's not capitalize that. Let's bold it though. When all items in the sample have a similar value. So when do we use mean per unit? When they have a similar value. So if they're all like around 5,000, it's a good one to use. And by the way, a lot of these can be used at all different places. Like for instance, this mean per unit. If you wanted to figure out the average, or the like, what's the total pounds of the ducks on the pond? You could go scoop up a duck, and I imagine that like ducks are probably about the same weight. So you could weigh the duck, and they're all going to be about the same size. They only get so big and all that kind of stuff. So you could probably weigh them, and then you could figure out, okay, if we have these 20 ducks that weigh on average this, we can multiply it by 1,000 ducks, and we can know how many things. So these are things that you can actually use for other things, but we're using. That's why they call it classical sampling. You can use it for a lot of different things. So mean per unit, if things are similar size, you can use it. Ratio estimation is this. Items in the sample have errors that are relative to the individual item's value. All right, and I'm going to make this, give you a couple of lines here later. In other words, oh, put in an expert love there. See, big value items. Big errors. Small value items have small errors. So if they're big, they generally have bigger errors than if they're small. Small dollar errors. For example, a big value, let's say that you have an accounts receivable for $6 million. You have a $6 million account. And you have you have an error, maybe it's like 50,000. Right? Now, if you have a small value account, let's say you have accounts receivable for $200, it's doubtful you're going to have an error of $50,000 on. You're getting groceries or something, and they ring it up and they say, "Oh, it's $50,000, $50,200." It usually doesn't happen. So usually they have smaller errors. So a $200 item may have an error of say $5. You wouldn't have a $50,000 error on a $200 account. This one is probably the one that makes the most sense for most accounts if you have a varied, if they're not all the same. Difference estimation. This is the wacky one. It's kind of the opposite of the ratio estimation. All accounts are likely to have errors all accounts are likely to have errors that are for the same amount. Oops. So this one says that they're all going to be, that the errors will likely be by the same amount. So if you have a $6 million account, it's likely to have an error of $5. If there's a small account, it's likely to have an error of $5. This would be if there's some standard, usually something that is like a normal charge that is frequently not made. So for instance, let's say there's a handling charge of $5. And for whatever reason, sometimes they don't put that on the sales order. Sometimes they forget to put it on. It's the same amount for everybody. It's $5. So if there's a $6 million account and it's off, it's likely to be off by $5. It's one that they forget all the time. And if it's a small account, again, $5, something they forget to put on the account all the time. So it doesn't matter the size, the error will be the same. I can tell you honestly, and I did auditing for a little more than 3 years. I never used a difference estimation. I don't remember ever use a mean per unit one. I can remember using the mean per unit one when I was at US Steel, and we had steel. It was a bunch of steel that was about the same value. We used it, but ratio estimation is probably the one that most fits most companies. That they'll have accounts that or items that vary in size. Ratio estimation is probably the one that I would imagine gets used the most, is the one we use the most. But so ratio estimation, and it makes sense that large items will likely have large errors and small ones will have small errors. That's usually the way it goes. But anyway, you look at your characteristics of the sample, and if they're all the same, mean per unit. If they vary quite a bit, this one, And this one's based on the errors. If the errors that are likely, say last year you did the audit and there was a bunch of accounts that were off by $5, you might conclude, okay, we should use the difference estimation because this is the one that, they're all gonna be likely off by the same amount. Questions? Let's take a break and let's do one thing here. We'll come back, we'll jump into the ethics. Let me share my screen here. All right, so let's say be back at 658, 708. Make it
Can
giant.
you go back to C, please?
Oh, let's see here.
Thank you.
Yeah, and it is a wacky one. I say I don't think I ever did that. I don't think I ever used that. Yeah, it's when they're all misstated by it's likely that they're misstated by the same amount. I've just been talking to myself for a while. Let me go back to what I was just saying to myself. We're not going to finish the chapter 3 handout today. But this one, the classical sampling, you should be able to turn that in. And again, if you have questions next week, go. So let's go to independence rules. And these are really taken seriously by the CPAs. And the whole idea is that the only thing we give to the financial statements are credibility when doing an audit. And if there's a problem with independence, it makes the whole thing suspect. And the independence has to be in both fact and appearance. And what I mean by in fact is that you are unbiased. You know, in fact, I'm not biased. But it also has to be in appearance. So, you know, let's say, for instance, I own IBM stock and I'm an auditor. Now, I might go in there with the idea of, hey, I'm an auditor for I own stock in this company. I want to make sure that these financial statements are accurately reported. I might be, in fact, very independent in that I want the, you know, but just the fact that I own stock might make other people think something's amiss. So it has to be both fact and appearance that we're independent. Now that also translates to our family and later family and friends that, you know, as far as what are these rules, how do these rules applied to individuals who may have family or friends that are maybe not independent. And it can come in two different forms. One can be an investment. You know, does anyone in my family have an investment in IBM? It can also be work related. Does anyone in my family work at IBM? You know, so you have these two different conflicts, employment and financial, that you have to worry about. And the US standards are very, you know, kind of strict. There's still a lot of areas for judgment calls, but they're very much, you know, can't do this, can't do that, that sort of thing. Whereas the international standards are much more laxed. Okay. So immediate family members can also cause conflicts of interest. All right, so, and here's the idea. Well, first of all, let me classify who are immediate family members. Spouses, spousal equivalents, boyfriends, girlfriends, that kind of stuff. Hey, spelled it wrong. And dependent children. So these are our immediate family members. Now, basically, these are all people who are living in the same house. You know, the people you see when you go home. So whoever you see when you go home, they are immediate family members. Now, you know, I have one kid living at home and one kid moved out, and the kid who's moved out is not an immediate family member. Now, I still consider him to be an immediate family member, but the AICPA doesn't. They say, no, that's not an immediate family member. We'll talk about what that is later, but dependent children. So someone who's at the home, you know, when you come home, who do you see? That's basically your immediate family. Okay. I'm not going to go into the international. Actually, the international rules, the last 2 pages have the international rules, and they're very vague, and they've actually had quite a bit of problems with them. I left them on there just in case you want to I don't know. Look at them. But anyway, the international standards are much more judgment oriented. Okay. Now, here's the thing. Let's just go to the US rules. Not wrong every time. Immediate family members are considered to be the same as the immediate, excuse me, as the covered member. So spouses, spousal equivalents, children, those are all the same as covered members. They make no differentiation between them and the covered member themselves. Okay. Sharon is a member of the audit engagement team. Okay, so we know she is a covered member. Peek up here and see what color, blue, turquoise, or whatever that is. She does not own any shares of IBM, but her husband owns 10,000 shares of IBM stock. Okay, family members are considered the same as the covered member. Is this a direct or indirect interest? A little tricky.
Direct?
Yep, it's direct. The husband is considered to be the same as the covered member. And at this point, it really doesn't matter because I didn't put this up here, and I should. Actually, there's two rules I should put up here. Hey, I'm going to take out these international rules. Hate space. Okay, first rule. Well, actually, they're the same as before. I'm going to copy them down from up here. Direct financial interests are prohibited. Sort of last time, the same rules apply. Indirect financial interests are allowed if they are immaterial. Oops. So these are the same rules that we had up on top there. But these still apply. So this is a direct financial interest. And it doesn't really matter what it's material or not. Although I would have to imagine 10,000 shares of IBM stock if I material, it's probably $2 million worth. But it really doesn't matter if it's direct, whether it's material or not. Is Sharon in violation of the rules? Her husband owns 10,000 shares of IBM stock. And whether it's material or non-material doesn't really make any difference because it's direct financial interest. Is she in violation? Oops.
Yes.
Yep. Oh, you would think if this was not material, you'd wonder why Sharon was working it. Or working on the audit. You know, if $2 million isn't material. But anyway. Yeah, she's in violation of the rules. Because and it doesn't matter, you know. Okay, Steve. Engagement team. I'll remember. There's no any shares of IBM stock, but his dependent daughter owns an immaterial amount of IBM stock. Okay. Is this direct or indirect? Now remember the immediate family. This is a dependent child. Consider it the same as the member. Is this a direct or indirect?
Direct.
It's direct. And because it's direct, it doesn't matter how much it is. We don't even have to go into it. If they say it's immaterial, I guess we can put that in. It doesn't really matter. Was Steve in violation of the rules?
Yes.
Yep. Okay, Jolene is a member of the audit engagement team for IBM. Okay, so she's a cover member. And she does not own any shares of IBM stock, but her husband has a large investment in a technology fund. 40% of the technology fund holdings are in IBM stock. Okay, so her husband doesn't have any direct investment in IBM. So he has a fund, a technology fund. He has investment in it. So is this direct or indirect?
Direct.
Actually, it's going to be indirect. The technology fund is kind of in between. However, a large investment, so you can assume that that's probably material, but 40% of the fund, I didn't mark it, sorry, it's indirect. But 40% of the fund is in IBM stock. So the question is, if the value of IBM stock changes, will this change the fund investment? Will it materially change the fund?
Potentially.
Probably, yeah, because 40% is quite a bit. If it's Standard & Poor's 500, that means there's 499 other companies. But if this is 40%, it's quite a bit, and if it goes up or down, it probably has a pretty significant impact on it. So this would most likely be material. And whether this was owned by Jolene or her husband doesn't really matter. Is Jolene in violation of the rules? You can have indirect, where did I put it? Here. You can have indirect as long as it is immaterial. But since there's a material amount in that, and there's a material amount in that fund, most likely she is in violation of the rules. And that would be whether she owned it or her husband owned it. Would matter. And there is still a judgment there. Okay, so if 40% is material, what is 4% material? Is 20% material? You run into those kind of questions as far as what's material. So even though these are kind of can't do this and can't do that and all that kind of stuff, there's still some judgment there, because what's material, what's not material, especially those things, those indirect investments. Determining what's material and what's not material could be somewhat difficult. And judgmental. Okay. So we have these two separate sets of rules. We have immediate family members are held to one set of rules, and close relatives and friends are held to a different set of rules. So, and by the way, these are, close relatives and friends. You know what our friends are, but so what would be close relatives and friends? Your parents, siblings, non-dependent children, those are usually what they consider, although it could be other people too. And we know what friends are. Or do we? Yeah, so, I'll put that in there, I guess. But there could be other people in there too. For instance, let's say I have a second cousin. This is my second cousin, close relative. Well, if there's no other information, probably not, but you don't know. A second cousin, maybe I raised a second cousin like my own child. You never know those situations where it could be that somebody else is considered a close relative or at least a friend. You could fall into that category. So there is a lot of gray area. They used to in the past, like years ago when I was going through, they would have, you could send in and say, I have this situation. Is this a violation of independent? And they would actually make rulings on them, and they would post those with the idea that somebody else might have the same thing. This is before the internet and all that stuff, so these were like published. And they stopped doing it after a while because they just got into the hundreds. I can't remember how many hundreds they were when I was there, but there's all these, this, but then, they own a business to my aunt who, all these like wacky situations. And they used to have a big list of them, but it really was kind of cumbersome. Okay, so close relatives. So what are the rules for these people? The rules for these people are they own direct financial interests the interest is immaterial to the owner. I'm sure there's a better way to write that. So maybe my wife or a friend. I should show her that. Look what I wrote. What? When you call each of those students and apologize. All right. So one, they may own direct financial interest if the interest is immaterial or not. I think a good way to write this. Cannot own I should say Indian. Actually, this could be any interest. Yeah. It is material. Now, here's the wacky part. Unless a material interest is unknown to the covered member. All right. So they may own interest as long as they're immaterial. So any interest that's immaterial, these close relatives and friends can own it. They can't own a material interest unless the material interest is unknown to the covered member. So if the covered member doesn't know about it, they can own a material interest. If the covered member is aware of it, then it's a no-no. So if it is unknown, there's probably a better way. If it's unknown to the covered member, you know, and you know, you gotta go back to who you're talking about. You're talking about like, you know, siblings and yeah, so you may have people who haven't talked in 20 years. You know, okay, you know, I haven't talked to my brother in 20 years. Does he own any IBM stock? I have no idea. You know, so you know, you can have those situations where it can, if you don't know it, you can't possibly influence the audit. And again, this has to do with it. They're not living under your house. It's assumed that everyone living under your roof or with your you know, in your home, that you know what they're up to and they know what their investments are and that sort of thing. As you get away from home, if it's unknown, you don't know. You know, I don't ask my brothers and sisters what they own. You know, it never occurred to me to ask them what their investments are. So you know, you can have that where even if they do have a material investment and you don't know about it, it's not going to influence the audit. Okay, so let's go back here and okay. On as a member, the audit engagement team. And let's fill in the blanks here. Oops. No, don't do that. Okay, so she's a covered member. She's not owning any shares of IBM stock, but knows their sister owns 500 shares. The IBM stock is immaterial to her sister. Okay, so this is a direct interest. It's immaterial. Is Wanda in violation of the independence rules?
No.
Nope. Immaterial. So they can always have an immaterial, whether it's direct or indirect. They can have an immaterial interest in the client. Okay, Stacy. Remember the engagement team. Okay, let's do the usual covered member. Whatever knows her brother owns 300 shares, direct interest. IBM investment is material to her brother. Stacy in violation.
Yes.
Yep. Again, this, it depends on whether it's material to the individual. So notice this one, even though this is more stock, 500 shares, it's a material to, doesn't say who her sister is. Her brother owns 300 shares. Yeah, so this is the material. So this would be in violation. Okay. Large member of the engagement team. Don't remember. You don't answer that, but his father has a material investment in IBM. Lawrence does not know about his father's material investment. Is Lawrence in violation of the dependence rules?
No.
No, very good. This is like this is the first time this class got this right. Unless everyone says, "Oh wait, it's covered members, direct, it's material." Yeah, not if they don't know about it. If they don't know about it, then they are not. And if you think about it, it wouldn't have any impact on the audit. If Lawrence doesn't know anything about his father's investment, he's not gonna. There's no chance that it'll be. So. No, he is not. So that's kind of a weird thing. Covered member, the direct interest material doesn't know about it. Okay. May. Member of the audit engagement team. Covered member. Did not own any IBM stock, but her mother has a material investment in IBM stock. May knows about the IBM investment and asks her mother to sell it. Her mother refuses to sell the IBM stock. Is May in violation of these rules, of the independence rules?
Yes.
Yes. You might wonder why I put this one in there. There's actually been lawsuits on this. Because you gotta, if people have a right to make a living, and this is through no fault of May's own that her mother just refuses. Thanks, Mom. But yeah, so it this is I know there have been lawsuits. I don't know how they've been decided, but there are people that said, look, I have no control over this. I can't, you can't hold me to an independence problem if I don't have any control over it. So anyway, but yes, under the rules, she is in violation and she cannot be on the audit. If I was her, I'd go live in the mom's basement. I like that, Mom, I live in the basement. All right. For some reason, yeah, we'll go through this. Okay, yeah, this is this one's kind of like, maybe a little different. Oh, okay, no, we can't. Yeah. Yeah, I got the Dracula cam on. All right, let's see here. That's from last time. Okay, so here's kind of the different scenarios we have here. So employment interest. Looks funny. Looks even worse. Those are little stick. All right, so here you have a CPA firm. And here you have the client. And just for kicks, I'm gonna say IBM. Okay. So it's possible that an employee from IBM takes a job with the CPA firm. So, you know, it's an IBM employee takes the job. This is very uncommon. But we'll go into the rules for that. So this is one scenario of someone, an employment interest, someone going from the IBM client to the CPA firm. Okay, so let's see here. No, I'll tell you why it's on kind of second here, but employee cannot audit any part of the client that included their own work. Maybe auditing themselves. Oops. Okay, so Gracie worked in the IBM accounting department. And was recently laid off from her position. Gracie took a job with the IBM's auditor. Can Gracie participate in the IBM audit? She was in the accounting department. What do you think?
No.
No, she can't, because if she was doing work in it, she would probably be doing accounting stuff, and those be on the financial statements. Now, if time goes by, a year or two goes by, whatever, and then those financial statements no longer had any of her work, then she can participate in the audit, and especially on those things that she didn't have any, she didn't do. But now, if she came from a different department, let's say that she came from marketing and went to then she certainly could start working on it. And notice that, you know, that's not me. The eyes look different. Notice that the, you know, it might be someone say, well, maybe we'll put Gracie on it. She used to work there. You know, that may be a very tempting thing to do, but you can't do it because she'd be auditing them. And so, but because of that, the independence. This is a very rare occurrence, and it's a very rare occurrence because it's very unlikely. It's not nearly as common to have an IBM, when someone going from the IBM client to the CPA firm. The CPA firms they don't like stealing employees from their clients, and their clients might not like it either. But
and again, usually the CPA firms, they hire their own people from colleges and so on. They get their own people through the internships and that sort of thing. So, you know, it's very unlikely to, could it happen? Yeah, I'm sure it does sometimes, but it's very uncommon. A much more common one though is the CPA firm. Remember, the turnover is very high in these because they need to get people who can be partners at some point. So this is very common to have someone go from, you know, the CPA firm to the client, IBM. So you call up, you know, hey, we got this senior auditor, we don't have a manager spot, or can you do you have a spot? Oh yeah, sure, send her over. We'll send her, you know. We're usually pretty happy to get them. So this is very common to have it go, you know, whereas this is uncommon. So going from the CPA firm to the client is a very common thing to occur. Okay. If the client is a non-issuer, so private, so prospective employee taken off of the audit if they have one, accepted the offer, or two, still contemplating it. Okay, so contemplating the offer. I don't want to capitalize the offer. Okay, so I'm working for the CPA firm and I get this offer from IBM. And it looks funny. Okay. Oh, I know, I had a O instead of a zero instead of. Okay, so if they've accepted the offer or are still contemplating it, they must be taken off of the audit. So these audits, you know, you'll be on the audit, you'll be on the audit team, you know, year round. And so if I take this job at IBM, if I accept the offer, they say, okay, you can't be on the audit team, you know, because it's gonna be your new employer. But also, if I have not rejected it, if I'm still contemplating, well, I might take it, I might not. I have to be taken off the audit until I reject it. Now, if I rejected the offer, it doesn't matter, you know, because I'm not going there. It won't make any difference. But if I'm still contemplating, if I have not rejected the offer, then I still must be taken off of the audit until I make a decision whether to take the offer. Now, if the client is an issuer, first of all, these same rules apply. Just because they are covered by, you know, federal rules, doesn't mean these state rules basically don't apply, or the ACCT rules. But we have one more. if the prospective employee applying for a key, key financial, not K, key financial position. But the audit for an entire audit cycle. Some places you'll see they say to off the audit for an entire year. It's actually could be more than that. You must be off of the audit for an entire audit cycle. So that's what we don't mean by that. So they still have to follow this thing if they're contemplating it. But if it's a key financial position, and it has to be a key financial position, it can't just be a one of the mill accounting job or something like that. But if it's a key financial position, someone who could influence the financial statements, then they have to be off the audit for higher audit cycle. Done with this. Okay, so like so let's say this is 2025, 2026, 2027. So let's say that someone gets an offer for a key financial position. Let's say that they got that offer on March 1st, 2025. They were still on the audit during this audit cycle. They have to be off it for an entire audit cycle before they can take it. January 1st, 2027, they could take the job. They have to be off for an entire audit cycle before they can take it. So even though they may have got the audit, two months into 2025, they can't take they can't be hired in a key financial position until 2027. Now, I say, gee, that sounds a little harsh. Why is that? Well, a lot of times these people that go into key financial positions are people who are very up in the CPA firm. They don't just take somebody who has 2 years of experience and put them in as the controller, chief financial officer of IBM, right? So these are often people high up in the audit firm. So these are people that oftentimes these auditors are reporting to. So notice that it could be a real problem. If let's say that I have a manager that, I report to, who takes a job as the chief financial officer, say at IBM, I could very well be sitting across the table from that person during the audit. And notice that this is also someone I probably want to get a recommendation from, at some point. So that could be a real problem because, now you have someone who has inside the company who may still have a tremendous influence over it. So that's why they say it has to be offered an entire audit cycle. You know, it can't just, it's not just 1 year, like sometimes they'll say it has to be a year, but they have to be off the audit. The entire year. But this is why. Now, actually, the onus isn't put on the auditor getting it. This is put on the companies that are doing it. This is only for publicly traded companies. And it's a rule from the SEC saying that you cannot hire someone for a key financial position. You know, unless they've been off the audit for an entire audit cycle. So the company cannot, and the company will be in violation of SEC rules if they do that. So it's one of those, and I'm kind of surprised it hasn't been challenged yet, or maybe it has, but still up there. Okay, so let's go through here. Issuer, Sam is a member of the IBM audit engagement team. He is offered an IBM job. Sam has not accepted or rejected the IBM offer. Can Sam work on the IBM audit? It's a publicly traded company, so this is an issuer. Can Sam work on the audit team? What do you think? Flip a coin. We're so close, you guys.
Yes.
Actually, he cannot work on it
Huh?
because he has not rejected. If he rejected the offer, then he can. But if he hasn't accepted it or rejected it, you know, then he cannot be on the audit until he makes his mind up. Now, if he makes his mind up to take it, then of course he can't be. George is a member of the IBM audit engagement team. He was offered a job at IBM. The job is for a staff accountant. Can George immediately take the job? Okay, so this is a issuer. So it's these rules here. Is a staff accountant a key financial position? What do you think?
No.
So can George take it? Yes. And the reason being is it's not a key financial position. Yeah, I mean, he's gonna be doing his accounting work, but he's not gonna be able to, you know, have control of the financial statements. Lisa, a member of the audit engagement team. She recently got a job offer. The job is for the controller position. Can Lisa immediately take the job offer? The controller, a controller is sort of like the head account, the top account company. Called controllers. Can she take it?
No.
No, key financial position. Now, 15 is the wacky one. This is a non-issuer. This is here. Mickey is a member of the GeoCorp audit engagement team. GeoCorp is a privately held company. She got a job offer from GeoCorp as their chief financial officer. Can Mickey immediately accept the job offer? It's a non-issuer.
Yes.
Yes. I am so thrilled with you guys. You guys are the only group I've ever had that got both of those right. Yes, she can. She doesn't, these rules don't apply to her. Key financial position rules don't apply for her. If she can take the offer, yeah, she can just walk right into the key financial officer position. Now, notice a lot of times though, too, you know, smaller companies, if you're in an audit firm, if you did get a job offer from a smaller company, you probably would want to have it at a higher, level up. So it isn't uncommon to have, if they only have like 5 people in the office, yeah, you probably would be the chief financial officer, came from a CPA firm. So a lot of times the size makes a difference with that. But yeah, if it's not a publicly traded company, you're not hindered by those rules. The SEC has no control over companies that are not publicly traded. Can't do anything. Okay, let's stop there. And we'll pick this up next time. There's a lot in this. Let me see. We should be able to get through it next time. A lot of this, it looks like a lot, but a lot of times it's. And we're not gonna do this. We're not gonna do the independent. You can look through these and you'll see that they almost all say, well, it depends, well, it depends, it depends. They don't really come out and say one way or another. And you'll find that's true with all of the international standards compared to the US standards. US standards are very well, can't do this, can't do that. International standards, like, maybe, so it's kind of 2 different ideas behind it. There's pluses and minuses on each side of that. Anyway, so what to turn, so you had to work on those sampling thing, and if you have questions, we next class, it's not due till Friday of next week, so if you have any questions on that. And if you have not turned in, I know many of you have already turned in the exam, make sure you turn in the chapter 1 and 2 exam by this. Right, well, this Friday, I'll be start going through the exams and putting the grades in. So you can still make it up, even if you don't make it by Friday, you can still put the exam and you get full credit. However, your grade's gonna look bad until you get it in. So, any questions? I'm 1 minute over. I'll make it up to you guys next week. Question? Okay. Good night.
Good night, Professor.
Good night.
Have a good one.
Right.
Thank you.